Good afternoon and welcome to Gray & Gray's Accounting for Obamacare webinar exclusive to McDonald's owner-operators. My name is Mark Heshkagan and I'm the partner who manages our firm's McDonald's practice group. We are very pleased to have so many McDonald's owner-operators from around the country with us today, and we do appreciate all of you making and taking the time for this very important presentation. This will be one in a series of webinars that we will host on healthcare reform. Today's webinar will focus strictly on the law as we know it. We believe there will be many more changes once the Department of Labor and the Internal Revenue Service put their arms around the law. Therefore, we will not be recommending what you should do at this point other than to understand the law. The National Owners Operator Insurance Team, known as the NOIT, has been fully engaged in this reform and is presently creating a tool that owner-operators and their advisors can use to help determine the best decision your organization should make. It is my opinion at this time that this will not only be a financial decision, but more importantly, a business decision. Before we begin, I just want to give you a little background about Gray & Gray and our long-standing relationship with McDonald's franchisees. We've been working with owner-operators for over 50 years now and have developed a very specialized and dedicated McDonald's practice group. We provide all the services you'd normally expect from a CPA firm, but also including accounting and tax work, and going well beyond that for our McDonald's clients to include all the financial analysis and reporting specific to McDonald's. As a result, we've become the leaders in accounting services for McDonald's franchisees across the country, working with dozens of owner-operators on everything from planning to rebuild and reinvestment strategies and to personal financial planning. McDonald's is a vital core to our business, and we have become just as vital as a trusted advisor to our clients. If you have any questions about today's webinar, about our services, I would hope you'd call me after today's webinar. I'd be happy to talk with you. Now let's get on to the real topic, and that's accounting for Obamacare. Mike Coppell, who's going to be giving the presentation, has been closely involved with this legislation since its inception and is adept at translating the complexities of these laws into a language we can all understand. So without further ado, Mike, it's all yours.
All right, to start off with, I have a question here. Do we have the state exchange plans, or can we use our current BCBS McDonald's plans? And basically, that's something that's going to be covered by the group that's being put together by McDonald's. But you know, there are very, very specific things that have to be put together by the exchanges, number one, and state plans, and I don't know exactly what McDonald's plans are going to put together or not going to be put together. That's something that they're going to address, I guess, in about a month and a half from now with a national seminar to all the owner-operators to try and clarify what McDonald's and McDonald's national insurers are going to present. So from that point of view, I'd like to be able to answer that more, but I don't think we're ready to at this time yet. Okay, there is my picture. There is my office email address. There is my the telephone number at the office. You can reach me there. I check my mail periodically. I will be away next week on the high seas with my beautiful wife down the Caribbean, so I won't be answering anything next week, but I'll be around the rest of this week, and then I'll be back after that week that we're talking about. I have a rule, all right, and I've tried very hard to live by this rule in all the speaking engagements that I've done for the last 35 or 40 years, and that is that it is my feeling that as the moderator, presenter, whatever you want to say, that I should not be taking a political position. In your questions, if you want to ask a political question, as long as it's not too, well, whatever, we will try and answer it and respond to it. But my position is that I should not be making any political positions. This is a highly charged political topic, but basically we're not talking about the politics of the situation. We're talking about what we know about Obamacare or PCACA, depending upon how you want to talk about it, the way it stands today and the way we think it's going to go. Now, long ago, or it feels like long ago, when I was a young accountant at Coopers & Lybrand, I had a mentor, and that mentor's famous words to all of us tax people was, "Don't let the tax tail wag the economic dog." Same thing is true in this situation. What we're going to be talking about here is you are going to have a choice, and you're going to hear a lot of discussion about the choices that you have to make over the next few months with regard to pay or play, whether you should be providing insurance to your employee, health insurance to your employees, or whether you should be letting them go out and buy insurance through the various exchanges that are available. What you have to really look at here is there is more involved than money, and that's something that Mark hinted at. There's a lot that you have to look at here. This is going to be a very, very complicated decision that you're going to have to make for yourself and for your employees and for your community. And it's something that you really have to weigh very, very heavily, and it's something you're going to have to talk to all of your advisors about over the next few months. Now, one thing that I do want to make you aware of, one of the things that you're going to hear a lot of people say is that it may be better for your employees, especially for your lower paid employees, if you do not offer them health insurance. And the reason for that is that there is what's called a premium assistance credit. And that premium assistance credit is going to be available to anyone that makes up to 400 times the federal poverty level. Now, put that in perspective. That means that based upon 2012 numbers, which is the last ones that I was able to look at, somebody will be able to make approximately, a family of four, approximately $94,000 a year and still receive some premium assistance credit. So you're going to have a lot of discussion about that. That is something that it's going to have to go, you're going to be aware of, and is going to have to factor into your discussions as to whether or not you do or do not provide health insurance for your employees. But what I really want to talk about is what's called the shared responsibility for the employer, which is what you have to do, whether or not you have to provide insurance for your employees. Now, Mark mentioned that we're going to talk about it based upon the law, and that's the law as we know it today. As of now, we are dealing with 2,600 odd pages of PCACA, of Obamacare, which are almost unintelligible, and several sets of regulations which have been issued by the IRS and the Department of Labor. These were issued in temporary form, which means that they're saying, this is what we think we're going to say. We're not sure that's what it's going to be, but you can use these regulations for now. All right? We're going to be keeping track of this, seeing what changes, what doesn't change. We already know that there are going to be a couple of changes on the horizon based upon things that we have heard. Everything we're going to be talking about for the rest of the day is based on these temporary regulations, and that's how that's what we're going to use to talk about. They are all available to be used in 2014. We don't know what's going to happen past 2014. We don't know if the rules are going to be changed slightly, or how they're going to be modified. So pay or play comes into case. Do you want to pay for insurance, or do you want to pay a penalty? Please notice the word I used is penalty. All right? We are talking about penalties here, and we'll talk about why this is a penalty in a little while. Do not be confused. Those of you that follow judicial law and followed what happened coming out of the Supreme Court last summer, notice that they used the word tax when they used the word tax, they were talking about whether or not government has the ability to tax an individual if they do not purchase health insurance. It had nothing to do with what is going to evolve for the employer. That's an entirely different situation. So, first thing that we have to understand, and there's a whole myriad of things that you have to understand. And the first concept that you have to understand is that if you decide to provide health insurance for your employees, it has to be affordable. And the way the law defines affordability is the law says that the employee can only contribute to their plan, their single plan. We'll talk about the difference between single plan and family plans in a minute, but they can only contribute to their single plan 9.5% of their household income. Now, I've done this presentation a couple different times in a couple of different locations, and one of the things that people say to me is, well, how do I, the employer, determine household income? I have no right to ask my employee how much their spouse made, how much their interest, dividend, capital gains, and so on is. And that's absolutely true. You have no right. And the IRS has addressed that situation. And what the IRS has said is that instead of using 95% of the entire household income, the 95% can be based upon the individual's W-2 income. Now,
I think you're meaning 9.5%.
What did I say? 95? 9.5%. 9.5% of their W-2 income. Now, obviously, there's an issue here. The issue is that someone's W-2 income is going to be less than their household income. So that even though the IRS has given us an easier way to determine this 9.5%, that 9.5% is going to probably be less than is stated in the actual law, because we really have no way of getting at the amount of household income. So basically what you have to realize is that you're limited to 9.5% of what someone makes. So simplistically, if someone is making $10 an hour and they work 2,000 hours, that means that they make $20,000. 9.5% of $20,000 is $1,900. That means the most you can ask that employee to contribute to their single health insurance plan is $1,900, regardless of how much it costs. All right. Now, you're going to say, well, what about a family plan? You can charge the family plan as much as you want on top of the 9.5%. So let's suppose, for example, and let's make the numbers simple so that I don't need a calculator. Let's suppose that a family plan costs $20,000, single plan costs $6,000. So basically what that means is that the employee can only contribute $1,900, so that if it's a single plan, $1,900 minus the $6,000, they have to contribute $4,100. However, if they have a family plan, think about what they're going to have to do. You're still only going to contribute, all right, that same $4,100, but they're going to have to contribute the entire $15,000 plus in that amount. So that basically that's the first thing that comes into play. There's also another quirk in the law, which I don't understand why it's there, and that is that you're not really required to provide a family plan. You're required to provide a plan that covers your employee and their dependents, other than their spouse. Why the spouse is included, I have no idea, but basically that's the way things are currently set up. I don't know personally, and I've spoken to a bunch of health insurance brokers and so on. I don't know of any plan that would exclude a spouse, but it's just kind of one of the interesting things that is in the Obamacare. The next thing you have to understand is that not only does the insurance have to be affordable, it has to provide what is called minimal essential coverage. Now, if any of you are in Massachusetts, these words may sound familiar, but not exactly what we have in Massachusetts, and we'll talk about some of the other states in a minute. The federal defines minimal essential coverage to mean that it has to cover 60% of the actuarially computed estimated medical cost. Don't ask me how you figure that out. I'm not an actuary. I have no idea how you do that. But what this says is that the insurance that you provide only has to cover 80% of the estimated medical cost. All right? Now, some of you have heard, and for example, those of you that are in Massachusetts, you know that in our, what is effectively our exchange, the connector, you have different levels of insurance. You have gold, silver, bronze, and platinum that have different levels of coverage that have different estimated costs. Same thing is going to be true in all the exchanges that are going to be required by Obamacare, so that basically the lowest level that is going to be provided in an exchange, the bronze level, is going to be the 60% of estimated medical costs, which is what you are forced to provide for your employee. Once again, this is something that you have to look at. Now, I had an occasion, one of our friends is a former president of one of the major Massachusetts health insurance companies. And he said something that I thought was very profound. He expects that there's going to be a major industry that is going to come up that says, okay, your employer has provided you medical coverage that only covers 60% of your medical costs. We will sell you something that covers the rest of your medical costs. Just for example, like Medicare. So that, for example, I'm 65 years old, and I'll be going on Medicare next year for various reasons, and I will be able to buy additional coverage to supplement my Medicare. They expect that the same thing is going to be true in this situation, where there's going to be additional coverage that people are going to be able to buy to cover the estimated additional cost, because the minimal essential coverage doesn't really cover as much of healthcare costs as it would be expected. Related parties, long ago, people thought that they were going to be able to circumvent Obamacare by having separate entities and having each of your stores or group of stores in separate entities. That doesn't work. Basically, any entities that are under common control, technical terminology is based on common control under ERISA, which gets even more complicated. Any related parties are going to be brought together, and you're going to have to provide similar insurance with regard to any related parties you're going to have. So that gets to be really, really important when we start to deal with some of our calculations. Now, if an employee is provided with affordable minimal essential coverage, they are not eligible for premium assistance credit. This comes into play, and again, you're going to be having a lot of discussions through the group that's being put together by McDonald's and others as to whether or not you should be providing health insurance to your employees. But what this says, if you are providing them the opportunity to provide affordable, qualified coverage, then they can't go to the exchange and receive premium assistance, which comes back to the question of, in some situations, and again, this is extremely complicated, in some situations you may actually be better off not providing health insurance to employees than providing health insurance to employees, which kind of sounds counterintuitive, but in some situations that's actually going to be the case. Beginning for months after 2003, all right, ACA generally imposes an assessable payment on any applicable large employer, and we're going to talk about what a large employer is in a minute, if one or more of its full-time employees is certified to the employer as having received a premium assistance or cost credit, etc. So basically what we have to look at, number one, is what is a large employer? Now, I will tell you as owner-operators that Mark and I have kind of looked at this, and anybody that is pretty much beyond a 2, maybe even a 1-store operator is going to be a large employer. So what is a large employer? A large employer is any employer, all right, that has 50 full-time employees in the workforce if it exceeds 50 full-time employees for 120 days or fewer during the calendar year, and the employer's workforce exceeds 50 employees that are not seasonal workers. Now, I know that the vast majority of owner-operators do not employ seasonal workers, so I don't want to spend a lot of time with it. But in some situations, up in ski country, down in vacation areas, Cape Cod, other areas where you may have seasonal workers, this may come into play, and this may complicate your calculation as to whether or not you have 50 full-time employees. Now, let's talk about how a seasonal worker is defined. A seasonal worker is a worker who performs labor or services on a seasonal basis, which makes sense, as defined by the Secretary of Labor, who has not defined it yet, all right, during a holiday season, whose work of employment is ordinarily declined, exclusively performed at certain seasons of the year, and which is by nature may not be continuous or carried on throughout the year. That sounds pretty obvious. That's the way we are defining this. But it goes a step farther, because what the regulations then go on to say is that through at least 2014, employers can define a seasonal worker any way that is reasonable. So if you are in that seasonal area, if you are up in New Hampshire or Maine in ski country, if you are down in the Cape, if you are down in Florida where seasonality comes into play, if you're in any of those places, you really have to sit down with somebody that understands and talk about whether or not a seasonal worker exemption will apply to you to get you out of the determination of a large employee. Hang on. Now, long ago, when I was young, a full-time employee worked 40 hours a week. Over the course of time, the full-time employee has kind of come down, and we now recognize a full-time employee as 9 to 5 with an hour lunch, or 35 hours. We now have a brand new definition of full-time employee. A full-time employee is anyone who works an average of 35 hours a week, or at least 130 hours a month. So this is a whole new animal. This is something that is brand new, a brand new definition of full-time employee that
Michael,
yeah?
Michael, you mentioned 35, but I think you meant to say 30.
The full-time is 30. All right?
Correct.
Brand new definition where anyone that works 30 hours or more per week is now a full-time employee for health insurance and health insurance only purposes. So that for other purposes, this may not apply, as far as whether or not things apply in entirely different situations for other types of fringe benefits. So how do we count? How do we count to 50? And we're going to talk about why this gets even more complicated in a few minutes. But Each employee who averages 30 hours or more is counted as one. You take all of those employees that are considered full-time because they work 30 or more and put them on a side, and each of them is counted as one. You now take all of your other employees, except those that are considered seasonal employees, add all of their hours together, up to 30 hours per week, and divide by 30, add that to the number of other full-time you had, and if that total is 50 or more, you are a large employer and you must provide health insurance or pay the penalty. This is why when Mark and I did this calculation, for most owner-operators in most stores, if you get up much over two, pretty much anything over 2 stores, you're going to be a large operator. So, but that doesn't mean that you have to provide health insurance. Remember, you can be a large operator, and as long as you don't have more than 30, as long as you're still sitting there, you can be a large operator, but you don't have to provide health insurance. All right? And we're going to see why it may still be helpful to you in a couple of minutes. An employer that offers its full-time employees the opportunity to enroll in affordable health insurance that provides at least minimum value is not subject to the penalty. So remember what this says. If you're a large employer, you have more than 50 full-time equivalent employees, you have provided your employees with the opportunity for affordable 9.5% of minimal essential coverage, and you've done that, that means that you will not have to pay a penalty because you have provided them that opportunity. But you've decided not to do that. You've made the decision that you don't want to give your employees the opportunity to buy insurance for whatever the reason is. All right? And there's going to be a lot of discussion whether it's good or bad. What is interesting about the calculation of the penalty is that the first 30 full-time employees are free. So what this means is that the basic penalty for not providing insurance is $2,000 per employee. Let's suppose that you have 50 full-time employees. You have 50 full-time employees. The first 30 are free, which leaves 20. I have 20 employees times $2,000. My penalty is $40,000, right, if that's the case. All right. So that's when Mark talked about the tool that is going to be coming out later in the year. That tool is going to sit here and it's going to say, okay, how much does this insurance cost? How much does it cost to provide my insurance? How much is somebody going to have to pay? How much am I going to have to pay? How many employees do I have? How many of them are free? And all of the rest of this that comes into play. It's a very, very complicated situation that you're going to have to do in order to figure out whether or not you're going to want to do this. All right. So there is one other situation, and I don't pay a lot of attention to this, but in some limited situations, if people do qualify for cost sharing and they go to their exchange and say, I wasn't provided the opportunity, therefore I want to get reimbursed by the government for a certain amount by cost sharing reduction, because that you are doing that, they're going to, instead of the penalty being $2,000, it's $3,000. Now, there's an interesting caveat here, and the reason that I don't pay a lot of attention to the $3,000 is that the way it's set up is the maximum penalty that you can have is based on the $2,000, not the $3,000. So regardless how many $3,000 penalties you have, regardless how many employees go to have a cost-sharing reduction, it doesn't matter. Everything is limited by the $2,000, and the models that I've seen basically say that everything is going to wind up being limited by the $2,000, not the $3,000. So that, I don't spend a lot of time worrying about what's going to happen with cost sharing in that situation. Remember the word penalty. All right. You guys are business people. You're out there. You understand that penalty is a bad word. The reason that penalty is a bad word is that you cannot deduct a penalty for income tax purposes. So basically what we're sitting here saying is that when you had, in my example, a $40,000 penalty, it's really more than $40,000 because you can't deduct it. So what you're going to have to do, and you're going to have to figure out when you sit here and say, which makes the most sense to pay or play, to pay the penalty or to provide insurance, you're going to have to say, you're going to have to take that penalty and actually cost affect it for tax purposes to determine whether or not this makes more sense for you or not. It just adds to the entire complexity of the calculation. To further complicate the matter, we now have another new term, and the new term is called a standard measurement period. And the standard measurement period is something that has come into play in the temporary regulations, and basically what it allows you to do is look backwards to determine whether or not an employee is full-time or not. So what you can do is you can take a standard measurement period, all right, and that standard measurement period is anything of 3 months up to 12 months to determine whether or not someone averages during that period of time 30 hours or more. So that basically you have the opportunity, and before you get too excited about this, there are some things that you're not going to like in a couple minutes, but you have the opportunity to determine, looking backwards for 2014. So you have the opportunity to look at 2013 for any 3 months or any 3 months or up to 12 months. Take all of the employees during the time they were employed. All right? Take what's called a variable hour employee, somebody that is not full-time but works different amounts based upon the shifts that they're on and what they're filling in and so on, and determine whether or not they average 30 hours a week during that standard measurement period. And that is something that you're going to do in 2013. So depending upon what you want to do, it is something that you're going to want to take a long, hard look at as to when do you want to do that, when do you want that measurement period to start and stop, and how do you want to do it. And that is something that you're going to want to sit down with your accountant and with your insurance advisors later in the year and determine what makes the most sense for you to determine whether or not you want to use the standard measurement period for 2014. I'm going to read this word for word because it gets complicated. If the employer determines that an employee averaged at least 30 hours a week during the standard measurement period, then the employer treats the employee as a full-time employee during the subsequent stability period, regardless of the employee's number of hours of service during the stability period, so long as he or she remains an employee. What does that mean? That means that during your standard measurement period, you took an employee and you determined that during that measurement period, they averaged 30 hours or more a week, all right, which made them a full-time employee. That person now has, during the stability period, and we're going to define stability period in a minute, during the subsequent stability period, they are a full-time employee who should be receiving all of their health insurance benefits, regardless of how many hours they work subsequently, right? Which, doesn't seem to make any sense on its face, right? But basically that's the way they are defining this. So what they're saying is, whatever you determine the person to be, they're going to continue to be during the stability period. Now, the stability period becomes interesting because the stability period is a period of at least 6 months, but not less than the measurement period. So think about what this says. That means that this employee who you determined works more than 30 hours a week and is therefore eligible for health insurance, is eligible for health insurance even if their hours drop to 10 hours a week in 2014 for at least 6 months. And if you determine your measurement period to be more than 6 months, be it 7 months, 8 months, 9 months, all year, they are eligible for health insurance during that period of time, that same period of time that you had for a measurement period. So basically what we're sitting here saying is you really have to spend a lot of time and really sit down with your advisors and determine what the measurement period you're going to use to determine what your employees are going to qualify as full-time, because it's going to carry over into the next year regardless of whether you cut their hours or not. So this gets to be a really interesting discussion that you have to have with your advisors, with your accountants, and with your insurance advisors, because this can be a really expensive situation. Now, the concept I just mentioned briefly is the variable hour employee, and this is another new term. A variable hour employee is someone that you hired. You did not hire them to be full-time. You did not hire them to be part-time. The amount of hours that they are going to work is going to be determined by you, the employer, on a weekly or monthly basis. So this can be somebody that is filling in for different shifts as things go by, and basically their hours can go up and down, and basically you now have to look and see whether or not that person averages to be 30 hours a week. And you're going to have to actually go through and calculate that and how much whether that person actually works 30 hours a week or not, during their measurement period. This is just one more thing that you're going to have to do. I attended a seminar, a discussion on this a couple of weeks ago, and a lot of people feel that unfortunately you may actually have to hire a person that is going to do nothing but keep track of all of the information that is going to be required to determine whether or not people qualify for insurance or not. I don't know how many of you out there are nerds like me, probably, hopefully none of you, but I read a lot of stuff, technical term stuff, and one of the things that I read is the Kiplinger tax letter, which comes out every other weekly, bi-weekly. And one of the things that they had in the most recent Kiplinger tax letter was a letter from the Department of Labor to a business, and it was completely redacted. All the names were taken out to protect the innocent or guilty, whatever they may be. But what really startled me was the amount of information that the Department of Labor was asking for in order to determine whether or not the business was properly doing all of the things that were required for health insurance. And one of the things that was interesting when I went back to the Department of Labor websites and so on is they said they are expanding this more and more and more in anticipation of what's going to happen with Obamacare. And they anticipate having more and more and more audits with regard to whether or not people are properly documenting and properly keeping all the information that is necessary with regard to Obamacare. No, wait, there's a question here. If they quit, so then they sue us for workers' comp and get insurance, and probably sue us for some type of discrimination too. I'm not going to get involved with that. That's a little political. There is one thing that I do want to double back on. There is a certain amount of discrimination that is allowed in the law, and that discrimination goes back to the standard measurement period. Standard measurement period doesn't have to be one period of time. There can be different periods of time that can be used for different standard measurement periods. Now, I don't know of any McDonald's owner-operator that has a collective bargaining agreement. Mark, do you know of any?
I don't know of any, Mike, no.
Okay. So basically, I don't, the first one doesn't apply. If you have people that are under a collective bargaining agreement and not collective bargaining agreement, those people can have different standard measurement periods. The second one, though, is very important, because you can have a different standard measurement period for your salaried employees and your hourly employees. And that may be something that is worth discussing, because obviously, most of your standard your salaried employees are probably going to be full-time. Your hourly employees, some will be full-time, some won't be full-time, and it may make sense to have different standard measurement periods for that. The other thing that comes into play potentially is that if you have different entities, all right, you can have different standard measurement periods. So that if your stores are in different entities, if you have a management company, for example, that is a separate entity from your operating company, those can have different standard measurement periods, and that may make sense. And the last thing in that area, as far as standard measurement periods, is that if you have operations in different states, if you have stores in different states, you can have different standard measurement periods in different states as well. So that what you can see happening here is that the complexity that is involved, and please understand, we're doing this at 25,000 feet of overview. There's a lot more detail that has to go into this that should be discussed, but there's something that we really have to talk about and look at. Now, there are 5 states that currently require health insurance. I know 3 of them. I apologize. I always mean to look up who the other 2 are, and I just seem never to get around with it. But basically, Massachusetts, Vermont, and Hawaii all have requirements to provide health insurance to employees. And the laws in all those 3 states that I'm aware of are significantly different from what is included in Obamacare. So the question that has been asked of me is, okay, what rules? The state rules or the federal rules? And basically, that's an outstanding question, and I have the answer. The answer is they both rule. So that what's going to happen, for example, and the one I'm most familiar with is Massachusetts. In Massachusetts, for example, Massachusetts has a lower threshold for the number of employees you have to have in order to start covering insurance. And our level of insurance, our minimal credible coverage, is higher than Obamacare's. So that basically what can happen here is you can be in a situation where you cover for Massachusetts and have an issue for federal and vice versa. I don't know if there's anybody on this line from Hawaii, but if there are, you guys have absolutely, I shouldn't say it's horrendous, it depends on which side of the coin you're on, but I mean the number of people that you have to cover for health insurance absolutely dwarfs anything that is included in any other state or Obamacare. Let me read this question. Are these periods determined individually by employee or as a group for the business. The the periods of measurement, standard measurement periods and so on, are by entity as I just indicated, and with those 4 caveats that you can do, how you do them, so that they are by entity. And then he gets into if they quit and so on, and they sue you. I don't want to get into that. That's political. But that's one of the things that you have to look at. The state rules and the federal rules are absolutely at issue for those people that are in those 5 states, and it is not going to get better. I know that Hawaii has indicated they are not going to change their rules to comply with federal rules. Massachusetts has indicated, Governor Patrick has indicated that he may be willing to move closer to what the federal rules are, but that was until they realized that the state Massachusetts rules are actually more strict than the federal rules, and they have kind of backed off from that. So we don't know what's going to happen, but right now it appears that those people that are in those 5 states definitely are going to have a difficult time and may be sitting there having significant double penalties. I don't think this is a major issue in the McDonald's world, but it is a major issue in the business world. The IRS has indicated, and I have no idea where they get this percentage, but the IRS has indicated that they believe that 60% of businesses have misclassified workers. And what they mean by that is they have made people to be independent contractors instead of employees. And as an independent contractor, obviously, as most of you know, independent contractors get no fringe benefits. They have no withholding. They have no unemployment insurance. They have no workers' compensation insurance, et cetera, et cetera, et cetera. They are totally separate and outside of the rules. The IRS thinks that this is going to be even further exacerbated because of the new Obamacare rules, where all of a sudden someone that is an independent contractor is going to be sitting there and they're not going to have health insurance, whereas if they were classified as an employee, they are. They have absolutely indicated that they are going to be significantly auditing both the IRS and the Department of Labor, significantly auditing more businesses with regard to worker classification. I don't think this is a major issue in the McDonald's system. But, if you think that you do have a situation where there is somebody that could be considered an employee, could be, all right, that you're currently considering an independent contractor, perhaps somebody that is a maintenance person that does maintenance for only you, all right, only you in your environment, in your different entities, that is somebody that the IRS and the Department of Labor would be looking at very closely to say, is this person really your employee and not an independent contractor? If you do have that type of situation, I strongly recommend that you sit down and you give me a call, give somebody in our tax department or in Mark's department a call. There is a limited amnesty period that the IRS is giving if you come forward and reclassify people properly up through the end of June. Again, I don't think it's big in McDonald's land, but if you think you have that situation, just give us a call and let's talk about it, because the penalties in this situation, once again, can be pretty fierce. There's a picture of Mark and his team. Mark is there in the middle. He's the handsome devil in the middle with his team. We obviously have a newsletter that is done specifically for our McDonald's clients, which is an outstanding Beyond the Numbers newsletter. And you can go and go on our website and sign up for that. or you could just call Mark or call our office, and they'll be happy to sign you up for it. It's a picture of Mark and I. Is anybody else have any other questions? Let's see what this one says. What are the calculations to find to put a part-time? Well, part-time and a part-time person is anybody that averages less than 30 hours a week. That's the way it's breaking down. We really have to talk about what's going to happen. The biggest issue that I really have is I want to really sit down and talk to people with regard to the standard measurement period and what happens with the standard measurement period if somebody is considered full-time during the standard measurement period and then their hours are cut back during the stability period. That seems awfully painful to me, and I know that's something that a lot of people have made comments about and may change in the final regulations that we think are going to be out sometime in the next 60 to 90 days. Are there any other questions out there? I don't see any. So I want to thank all of you for attending. If you have any questions, you can feel free to email them to me. I check my office email regularly several times a day. I will probably check it once a day while the wonderful Tina and I are on vacation down in the Caribbean. As Mark indicated, McDonald's has set up a group that is going to be doing a lot more work and giving a lot more answers in this area. We expect to have a lot more information to provide in this area as time goes on. You really have to sit down and talk to your advisors, especially talk to your advisors with regard to what they think you should be doing about standard measurement periods. If you decide that you're going to want to provide health insurance, that is a key thing that you want to consider. So once you decide whether you're going to pay or play, standard measurement period absolutely comes into play. So I want to thank all of you for listening to me for an hour. If you have any questions, feel free to email me, email Mark, and we'll respond to you as best that we can.
Absolutely, Mike. Thank you very much for a great presentation and for everybody else for participating today. Like I said earlier, it's going to be one in many webinars that we have. We'll keep you posted as the law unfolds. And as Mike said, I can't stress more to be in touch with your tax advisors, your business consultants, your CPAs. Be on top of this so that you make the right decision for your business. Again, we appreciate the time today, and we will be back in touch with you soon with our next webinar. Thank you.